Welcome back to our channel where we provide you with valuable insights into the world of real estate. I'm Marsh, and today we're going to dive deeper into the topic of owner-occupied real estate. So grab a seat, get ready to learn more about this fascinating subject. So let's start by understanding what owner-occupied real estate really means. Essentially, it's when a business owner purchases a property that their business or team works in. And this property can fall under various classifications depending on the nature of the business. So for instance, it could be an office space for an accounting firm or a retail space for a clothing store. By investing in a building or owner-occupied real estate, the business owner gains more control over their workspace. It provides them with the freedom to customize the property according to their specific needs, creating a space that aligns perfectly with their business objectives. Let me give you a quick example. I'm standing right now recording this video in the room above the garage in my owner-occupied piece of real estate that I finished because I wanted a room to be able to talk to all of you. So this building serves as the foundation of my business operations and it acts as a hub for my team to get together, collaborate, do things. So now I want to explore what the benefits are of owning an owner-occupied piece of real estate. So similar to buying or renting a home, the space where your business operates holds a lot of value. And not only does the building build equity, but you're also generating cash flow that can be reinvested into your business. You're not paying someone else. Owning your business space, it creates stability for your business, and it has a lot of other long-term financial advantages. So instead of paying rent that may increase over time and is controlled by someone else, you have the opportunity to build equity, create an asset that can appreciate in value, and this can increase the value and contribute to the overall net worth of your business, making it more attractive to potential buyers in the future. Another part for owner-occupied real estate for business owners is that it just provides a sense of permanence or control. You have the freedom, like I said, to design the space in a way that you want without having to ask permission. Now, you may need to ask permission of your township, depending on what you want to do, but you can have your brand image, you can have the type of productive work environment you want. And this level of customization can really impact your employee morale, your productivity. So now that you understand the benefits of owning a building in your business, you might be thinking, well, okay, when is the right time to purchase an owner-occupied commercial piece of real estate for my business? And the decision should be made when you have a solid, stable business that isn't at risk any longer. And before taking the leap, you want to start evaluating and doing some research and making sure, maybe check with your bank, check with a lender like Collab Capital, and make sure that you would be approved based on your business. So make sure your business is in a position that they can sustain the cost of owning a property and the maintenance and the taxes and the insurance. Now, one of the most popular loans for owner-occupied commercial real estate is what's called an SBA loan. And the SBA prefers to work with businesses that have a track record of around 3 years. So they will ask for 3 years of tax returns when approving a business for an SBA loan. Now, it's not to say they won't lend to someone who hasn't been in business for less time. It just means that if you have less time, you need a strong explanation where you were and if this time before contributed to a 3-year history in the same or similar lines of work. The types of loans that you want to look into for owner-occupied real estate is the next area that we're going to move on to. And the ones that are available to you, you might not be sure, because I know I wasn't when I bought this building. The most common option is a traditional commercial loan, which you can typically get from the bank that you have your bank accounts with. And this type of loan will require 20% down. There's also what's called agency loans that are backed by Fannie Mae and Freddie Mac, and they are attractive options for strong, qualified businesses and borrowers. They often come with more favorable terms, lower interest rates. Additionally, though, is the small business loan, the SBA loan, because this program offers specific benefits to small business owners when you are trying to build your business. And the biggest benefit is not needing that 20% down and being able to have a lower payment because they'll spread the payment over a longer period of time than our local banks will. So now let's just look at some of the differences between owner-occupied commercial real estate and traditional investment properties, in case that's something you're still a little confused about. One of the significant distinctions lies in the use of the building. And the use of the building means a business has to be using it for that business. Whereas if you're renting it to a different business, that's when it's an investment property. And when it's your own building, an owner-occupied building, you get lower interest rates, a lower down payment, and these can save you a lot of money in the long run. Sometimes even beyond having better terms for loans, there's also government programs out there to support business owners. Sometimes there's tax incentives or grants to encourage you to buy a building for your business. Now, the qualification process we briefly talked about, but when you're applying for a loan, when it's an owner-occupied building, a lender will look at your personal credit and your income, but also the financial stability of your business. It's a broader perspective that lenders look at to just make sure that your business is successful enough and can handle whatever that new payment is compared to what you're paying now. It's essential to also just acknowledge the risks associated with buying an owner-occupied piece of real estate for your business, because everything comes with a risk. And some of the risks include, okay, what if there's an economic downturn or an unexpected event, such as a global pandemic, which can impact your business operations and subsequently your ability to generate income for your business or for the property. So to mitigate these risks, it's smart to just do your research, make sure you know how much you could rent your building out for, the other uses that you could use it for, and just be proactive and always have a plan for your building. One of the things that I've done in the past and still am doing today is you can sublease out portions of your business. Since a lot of people are working from home now, we have found that some of our other businesses could use the space, and so we've subleased some of and gotten rent that covers some of the rent that we pay to ourselves. So hopefully that gives you at least a starting point, an in-depth exploration of what this owner-occupied real estate really means. Just remember, owning the space where your business operates can bring a lot of advantages and really contribute to the long-term success of your business. But if you have any other questions or thoughts and ideas, feel free to share them in the comments below. We love hearing from any of you watching these videos and knowing what questions we haven't even answered yet. And if you enjoyed the video and found it helpful, please give it a thumbs up and consider subscribing to our channel for more information and content about the world of real estate and business. Otherwise, stay tuned for our upcoming videos where we'll continue to provide valuable insights and tips. Otherwise, thanks for watching, and we'll see you in the next video.